Hi, it's Dre Griggs with the City and Wisdom. Today we'll be answering the question, where is the safest place to put my money in retirement? Most entrepreneurs and families worry about money, so we created the Wisdomites framework to help you eradicate financial stress, generate a passive income, and build a prosperous retirement strategy. When it comes to your money post-retirement or during retirement, it's a little bit different than the money that you have in your 20s and 30s and so on, where you want to start locking in some of your gains. You want to put your money in a safer place, but at the same time, you also understand that there's different levels of safety. So you know that, right, technically speaking, you can just take all of your money out of the stocks. You can sell all your real estate. You can sell your business, and you just kind of put all the money in your bank account and in a mattress, which is technically a safe place to put your money. If you're just talking about the money I put in, I want that money to be there when it's time to take it out. The problem that you end up having, or at least something that needs to be considered, is if your money is only inside of a bank account, then you're going to be getting like 0.001% or something back, which means you're not keeping up with inflation. And so if you can't keep up with inflation, then that means ultimately that you're losing money every year just by keeping it in the bank account. It was about 17 and a half years is when you lose like half of your purchasing power. So it is something that you have to consider. So as much as we may want the certainty of saying, okay, my money, I'm putting $1 million in this bank account and I'm still going to have $1 million unless I spend it, which feels really good. But you have to consider other safe places to put your money outside of just your savings account, at least until we start getting a return that at least matches inflation. The second thing that people would consider is maybe like a CD, a certificate of deposit. So CDs are nice because they're liquid, and you're going to get a little bit more of a return than in your traditional savings account. So that's good. You'll usually get around like a 1% return, at least currently. But again, the problem is you're not really outpacing inflation. So even though you have the benefit of your money being liquid, even though you have the benefit of getting a slightly higher return, again, you can't put all of your money into a CD post-retirement because, again, you're going to continue losing your purchasing power, which means that you're actually losing money every year, right? If you just assume that inflation is like 3% and you're going to make 1%, well, that means you're losing 2% every year to inflation. So it's an okay place to have some of your money, again, because it will be growing some, but you do need to have a portion that you're considering for inflation and making sure that I outgrow that. Now, what's considered generally the safest place to put your money, and it's going to have a little bit of growth. Again, you're not quite outpacing inflation, at least not yet, but again, we're getting a little bit higher. So that would be Treasury security. So there's Treasury bills, Treasury notes, and Treasury bonds. So Treasury bills are going to be considered the safest. They're the short-term ones. And your Treasury bonds are going to be considered your long-term Treasury option. So the Treasury is just basically debt that you're buying from the United States government. And because the United States is giving out the debt, the assumption is that, hey, Uncle Sam is going to pay back his debt, right? There may be a lot of debating and like political posturing and things like that. But when it ultimately comes to a head, the U.S. government is going to pay its debts. They're going to, raise taxes, print money, increase the debt ceiling, whatever they are ultimately going to do once they're done with the political posturing. The assumption is, hey, Uncle Sam's going to pay the debt. And so as long as you believe that the U.S. government is going to pay back whoever they ultimately get money from, then that's why the Treasury is considered one of the safest places. Now, how much you get depends, of course, on how long your term is, right? If your term is less than a year, you're not going to get as much than if your term is 10 years or more. So if you have a Treasury bond that's around that 10 years or more, then you're going to be close to around like 2% is what you're going to get. So you're getting really close to inflation now, and you still have some certainty. Now, you don't have the same liquidity because you're going to be giving your money for a certain period of time, and then you're going to get paid back based on that, whatever the pre-agreed upon interest rate is. So you will be trading some of your liquidity, but you'll be gaining a little bit when it comes to your overall return. So that's good for you in that sense. And then like a money market account, that's very similar to a CD. That's a very short term, very liquid asset. And you're going to be still not really breaking that 1%. So you're not keeping up with inflation. So these are generally the top 4 options that are available. Now, some will also consider a fixed annuity. So a fixed annuity is not the same as like a variable annuity and different ones with the bells and the whistles. But if you have just a traditional annuity in the sense that it's my personal pension, in the sense that, hey, I'm going to give you a certain amount of money, either a lump sum, maybe I get it at retirement, or I'm going to put a little bit in where it's a deferred annuity where I'm going to put a portion away each month or each year, however, whatever frequency you want, and then I'm going to annuitize it, and they're going to tell me how much money I'm going to be able to get for the rest of my life, that they're going to give me this check every month or every 6 months or every year, and then I get to spend that money. Generally, that will outpace inflation. Most of them are right around inflation, where it's going to be, somewhere around like a 2 to a 4%. Yeah, there are some annuities where you can pay for different accesses with different add-ons, but it is a fee, so it is something that you have to consider in the overall return. But, there are some annuities where they'll be like, hey, we'll guarantee you a certain return, maybe we'll be an index annuity and then we can get you to like 5%. But you're really teetering into something where you really have to read a lot of the fine print to make sure that it makes sense to you. We can at least say that no one goes into business with the idea of you give me $5, I give you 6 back, right? Like ultimately a business is supposed to be able to make some sort of a margin, some sort of a profit off of every instrument, every investment, every vehicle that they make. And so if you understand that, then ultimately in the back of your mind, you should at least be able to say, you know what, I can't 100% figure out exactly how this is working, but I do know that the insurance companies are staying open, which is good. Obviously, an annuity is worthless if the insurance company bellies up in 10 years before you're ready to retire or 10 years into your retirement. So you do want them to be around, but it is something that you need to also consider, that they're not just giving these instruments out of the kindness of their heart, that they're able to calculate different numbers and determine the likelihood of you living, how much you're going to get, and the rate of return based on that. Actuaries are incredible mathematicians, so you just normally want to believe them when they offer you something. Doesn't mean that it can't be mutually beneficial, but it does mean that you have to at least go in with your eyes wide open. The more things that they're offering to you, the more benefit that you feel you're getting up front, they'll know that they are recouping that in some way, that they are making sure that they keep their doors open, which ultimately is what you want. What you should have noticed from this list, I would say, is that you really can't just pull all of your money out of your investments, whether you're in the stock market or whether you have real estate. You can't just say, you know what, I'm going to retire now, so I'm going to pull out my money and I'm going to keep it safe with me. I'm going to put it in something short term, something liquid, and I'm going to make sure that my money has like zero chance of losing anything, because ultimately you end up giving yourself very close to a 0% chance of outpacing inflation, which is very important. So generally one of the options that's available is you're told, hey, let's put a portion of our money in the stock market that maybe matches our age, or at least within I've seen some that do the math where they'll say you just take whatever your age is and you subtract that from 110. So if you are, in your 20s, then you would have somewhere around 10 to 20% of your money that is considered safe. And so you'd have that in the Treasury bonds that we talked about, or in some CDs, or in something safe, maybe like a fixed annuity, whatever it is, that you have about 20% of your assets in something safe. And then you have the other 80 to 90% in aggressive stocks, because you have the time to grow it and make that back. And then at the same time, when you're 50 years old, you would consider being, okay, let me be around 50% of my money is somewhere safe, where I am starting to pull it out of the stock market, where I have about 50% still in equity, still relatively aggressive. And then I have 50% in something a little bit safer, where I'm only getting like that I would say like 2 to 5%, right? Where my money's a little bit safer. I have it in some treasuries. I'm starting to get some debt, where I'm purchasing debt where I have a certain guaranteed return, but at the same time, I'm not just pulling it all out and putting it in under my mattress, where now my money is just just not even keeping up with inflation. And then once you're maybe at like 65, 70, 80, that you can be anywhere from, like 30 to 40% of your money. If you're like 70, where you're like, okay, 30 to 40% of my money is now all that is invested in equities and in stocks. And then I have the other 60 to 70% now in something safe where we're able to make sure that this money is there for me. And however that looks for you in your portfolio. And then as you get older, you'll usually get somewhere around maybe like 25% of your money would be in the stocks. And then you would have the other 75. I've seen people go as high as like 15% of their money is kind of in their aggressive, whether that's in their business or whether that is in the stock market or if that's in real estate. Now, if you're someone that has real estate, you do have the option to say, you know what I will do is I'll keep my real estate, but I will start maybe getting a rental income where I can start pulling out some of the equity that's inside of my real estate without me actually selling it. And then you can use that money as just an income stream where you just constantly have that money coming in and you use it to pay bills. Or you can say, okay, I'm going to take that money out and then I'm going to put that in something safe where I'm able to at least try to keep up with inflation, at least hedge inflation a little bit. And so when it really comes down to where you're going to put your money after you retire, that's really going to have to do with like your risk tolerance and how much you understand how excited you are about these different avenues. But keep in mind that even if you're a little uncomfortable, if you put all of your money in a savings account, you're like, hey, I understand the savings account, my money's going to be there. You're not keeping up with inflation. So you do want to keep that in mind when you're talking about these short-term liquid assets. You do want to have your money liquid and you do want to have your money accessible as you retire and as you're going to start spending off of that money. But at the same time, you want to make sure that a portion of your money is at least covering itself so that you don't run out of money early. And if you have any additional retirement questions, anything I can help you with, I invite you to check out my Retirement Planning That Works video training at obsidianwisdom.com/training. In it, I'll give you the entire Wisdometric framework that I use with my clients to help them eradicate financial stress, generate a passive income, and build a prosperous retirement strategy. Until next time, Wisdomites, remember, wisdom is asking the right questions to allow yourself to get the right answers. Keep asking those questions and you will keep getting those answers. Continue blessings.